Welcome back to America's Commercial Real Estate Show. This segment is brought to you by the Apartment Group at Bull Realty. For asset and occupancy solutions, visit bullrealty.com. Well, today we're talking about apartments, the multifamily world, one of my favorite food groups, if you will. Please welcome my next guest is Tom Walsh, and Tom is Senior Vice President with Grand Bridge Real Estate Capital. They're a subsidiary of BB&T. Tom's here with us in Studio One. Tom, good to see you again.
Nice to be back, Mike.
So Tom, it seems like the multifamily world's been hot for a long time. We do see a lot of cranes. We do see and hear some people may be concerned about government shutdown and stock market volatility. How are lenders feeling about the multifamily world right now?
It's still the primary product people are looking for. It would be number one on the hit list for most people. There are probably some lenders out there that might put industrial above multifamily, but in general, multifamily is still highly desirable as a product type.
All right. And what would you say are kind of the food groups of sources for multifamily financing? You still have Freddie and
it's still very, very much of a Fannie Freddie world. And you could throw HUD in there to a lesser degree, but the agencies still are doing the yeoman share of the business. They both had significant years in 2018 with significant plans for 2019. HUD, if you want to call them the third agency, they're doing well. Life insurance companies are getting some multifamily. They're interesting in where they will compete is at the top of the market, and quality-wise, the top of the market, they'll go toe-to-toe with Fannie and Freddie. Once you get down into the middle part of the market,
meaning more B,
the B minus C plus type stuff in there, then it becomes a leverage question where they're not going to go max leverage in that genre, where Fannie and Freddie will. So there, if you're in a lower leverage situation, let's call it a 65 or lower percent LTV, you might have life company interest in the middle market. At the very top of the market, though, the life companies are going toe-to-toe, max leverage, IO, they're going toe-to-toe with Fannie and Freddie all the time. Okay.
And Tom, what are you seeing for trends on interest rates for apartment financing, kind of through 18, whether the trend's been, and what do you expect moving forward?
Well, which I'm sure most everyone's aware, the latter half of 2018 has been a bit of a roller coaster with interest rates, with indexes, whether it's LIBOR or Treasuries, going up consistently, spreads kind of bouncing around. The spread market does not like volatility, and it doesn't care which direction the volatility is going. It does not like volatility. And when you take the volatility that you've seen in the equity market over the last 90, 120 days, that has significantly impacted spreads, and spreads have widened. It depends on who you ask and what segment of the market you're in as far as what type of entity, but spreads have widened. It could be as low as 15 to 20 basis points. It could be over 50 basis points during this volatility that's going on in the stock market. When you add the fact that the Treasury has been consistently going up over the year, LIBOR has been consistently going up over the year, rates were getting pretty high. Then with the stock market, crash is not the right word, but a significant correction in the stock market, that has affected the indexes, especially the Treasury. Treasury rate is down, probably down 60 basis points, maybe 70 off its high now. So that has brought the rates kind of back, a lot of rates back into the fours. When, if you go back, say, 45 days ago maybe, most rates, other than primo low leverage stuff, most rates are starting to start with a 5. Now rates are back, a lot of them starting with a 4.
And what would they say a year ago for the same similar product?
100 basis points lower a year ago, probably.
Wow.
Yeah. There was a period of time there where we had like a rate nirvana there when we were locking long-term fixed rate deals with a 3 handle on them, maybe getting into the lower fours, which kind of almost unprecedented historically. Now we're probably actually back to more of a historical rate structure right now. Still, in all seriousness, it's still very favorable.
Yeah.
But the paradigm changes very quickly when rates are decreasing.
Right.
What you think is normal, all right, changes very rapidly, and to the point where, say, you may quote a rate, and the guy, oh my God, 4.25. I was hoping to be in the threes. Well, 4.25 on a 10-year loan on historical terms is really low.
That's awesome.
Yeah, So we're having to adjust our expectations, aspirations right now. Overall, though, especially on the multifamily side, the rate market is still pretty favorable.
Yeah. What about underwriting, Tom? As underwriting, where do you see the trend there? Is it stiffened any, or
no? It's been very, very consistent over the last few years. It's collections-based underwriting. We're not underwriting off of rent roll projections. It's based on what you're actually collecting in rent. It's historic expenses, maybe bumped a little bit depending on how far we're going back in history. Still, 1.25 debt cover is the bottom. Life insurance companies would probably tell you they would prefer to be in a 1.35 or better on debt coverage, but you can still get a deal done at 1.25. So there really hasn't been any drastic differences in underwriting. The only thing I would tell you is if there's a risk point out there in the market, people are concerned about rents in high-end in-town multifamily property, and which we've seen in many, many cities, a lot of in-town stuff, whether it's high-rise or wrap product. There's a lot of that product out there. By and large, we haven't built many units in the suburbs, hardly anywhere, really. Suburbs are actually doing quite well in most areas now. The in-town stuff is doing well, but people are worried as to what the cap is on, okay, how high a rent can we absorb here? Depending on your city, that might be a $4 a foot rent. In some other cities, that might be a $2 a foot rent. That's when you start to talk about $2,000 a month for a 1,000 foot 2-bedroom.
Yeah.
That's high. Yeah. And so people start to worry about how deep the market is of people who can afford to pay that.
Exactly. Affordability becomes the issue.
Yes, yeah. Not really demand. I mean, I would go, my personal opinion, I would almost go as far as to say that the demand is almost unlimited, but the governor on that demand is the price.
Right.
And there is only so many people that can afford to pay X for rent in any market.
Right. Well, I know you have a crystal ball, and you can borrow the show's crystal ball, but what would you say through 19 might we expect for interest rates on multifamily product?
I tend to think that you are still going to, there's a lot of fits and starts in interest rates, and you kind of have to look at the trend. For example, the 10-year Treasury has been going up now for a year and a half or so. But there have been moments like we're in today where it's dropped, it's gone up, it's dropped, it's gone up. You just look at the overall trend. I have to believe that the overall trend is still upward on the 10-year Treasury. Spreads and LIBOR, which I'm not sure what the schedule is for LIBOR to be replaced. There's another index that's going to take its place. I think the overall trend for LIBOR is probably also upward. However, recent noise coming out of the Fed as far as a bit of a slowing, it's a talk government speak, a slowing down of the growth of the Fed funds rate. You might see LIBOR's growth kind of that curve might dip a little bit, more steady and slow, rather than we've seen fairly significant LIBOR growth over the last couple of years. That might slow down a little bit. Spreads, it's very hard to predict spreads. Right now we have a lot of volatility in the market, especially on the equity side, and we saw a record day going up last week, followed by announcements that drove back down again. Then we have the jobs report last week that sends things back up again. All that volatility is negatively impacting spreads. If the market steadies, going into the new year, and we, if you want to use the Dow as an example, the Dow kind of finds a level that it starts to hover at. It's quite conceivable you could see spreads drop at that time. Once the credit markets think they kind of have a handle on where we are, then competition starts to push spreads down. All right. When you don't know where we are, there's too much risk, and everyone puts a cushion in their rates then, and that's where you get the spreads going up like we've seen recently.
Right, and you may be listening or watching this here in January of 19, but if you're listening to it later, that's where we are right now.
Yeah.
And so today, if you had a B plus, A minus property, 300 units, you might get a rate of what?
Somewhere probably between 4.5 and 5, depending on your leverage level. Right now, still, as I said, historically, still a favorable rate environment.
Yeah, and that may have been 100 points lower a year ago.
2 years ago, 100 points lower, maybe 50 a year ago. So, yeah.
Okay, and so it sounds like to me, as I translate all of that lender jargon, is that you're thinking that rates might be fairly level that apartment owners would see in the marketplace this year?
I think you will see, and I'm not an economist, all right, and I did not stay at a Holiday Inn Express last night, all right, but I expect that you will see the nominal, the actual note rate on your loan 12 months from now at the end of 2019 be somewhat higher than the rates are today. Can't predict how much, but
oh, come on, you
higher.
can give me an exact number, Tom. You've been doing this a long time.
Yeah, too long.
And studying. Well, what final tips would you give apartment owners, developers out there today?
Just do your financing in relation to your program and your strategy. If you're a long-term holder, then this is still a favorable rate environment. Let's go ahead and put long-term financing on it. If you're not sure if you're a long-term holder and you want to maintain flexibility, there's great ARM products out there. Life companies have ARM products. Fannie and Freddie have ARM products right now, still on a non-recourse basis, that will allow you some flexibility if you decide 2 years from now that you think the time is right to move out of that property. You can still get out. We do see people sometimes getting caught up in what's going on in the market, and sometimes they don't match their financing to their strategy. Not everyone has a strategy. And as funny as that sounds, it's really true. Not everyone really knows what the plan is. But I would say, match it up. Give yourself time. If you have a refi coming out, and we're going to get back into the market now, where 10 years ago we did have loans being made. We just came out of 2 years where 10 years ago there were hardly any loans made, so we didn't have a lot of refis.
Right.
We're going to start to get back into the market where there will be some refis. Start early. Don't wait until you get that notice that, oh, I got 60 days left, I better go look for financing.
Right.
That's a 120-day decision to start looking for financing.
Okay.
Just give yourself some time. And don't limit yourself to one. Don't go to a lender per se and take on faith whatever they say. You need to shop the market. You need to. It needs to be a competitive situation. Make sure you get the best possible deal.
Yeah, that's a good point. I have seen some investors that are very savvy. They go to maybe one bank or something and hear what they say, and potentially that bank may have all the multifamily loans they want, and they don't want to lose you as a customer. You don't know what they're going to say. No offense to my friends in the banking world, but if you're a businessman and operating properties, get multiple quotes. You said 120 days minimum if we're looking at a refinance. What would be a reasonable time range for a new acquisition?
That's a tricky question. We in the lending community, the mortgage banking community, we try to adjust to the purchase contract. Okay, we do get people that hamstring themselves though in some unrealistic time frames in purchase contracts.
Sellers want to close in 30 days.
They do.
No.
And that can be problematic on the lending side.
Yeah.
I can give you what we would have as the ideal situation.
Okay.
The ideal
The perfect
would be 30 and 30, a 30-day due diligence, 30 days to close, and I can buy another 2 weeks if I put up another X of deposit.
Okay.
That would be really a perfect situation for us.
What do you tell that borrower when his first 30-day due diligence period has expired and his earnest money's hard, when his loan is really still contingent on third-party reports? Take the risk?
Well, you're going to have to, but if he does it right, and he's working with a lender, say a savvy professional lender, as long as he didn't wait too long to start the process after he went active on his due diligence, we should know in 30 days.
Even the third party?
Yes. Okay. We should be, within 30 days, we should be 95% certain as to what the end game is going to be with that loan.
So if I've got a 30-day due diligence period and I come to you, then does that mean if you need an appraisal and an environmental and a property condition assessment, that you're ordering that day one?
We would get a deposit and order that as soon as possible. We would try to get the third-party reports to come into us before the end of his due diligence.
Okay.
That would be the
before
goal.
you know who's actually going to fund the loan.
No, usually we have a lender. And you've brought up an interesting topic. Is if you're a buyer, and let's say you've just been in best and it's best and final. You've been notified you're in best and final. Yeah. There were 50 bidders. Now there's 3. Okay, that's the time to call me. Okay, have me look at the numbers. Have me kind of look, yeah, this is a Fannie Freddie possibility, or at what you're looking at, we might be able to get a life company to do this, and start the process, if nothing else, mentally before you're awarded the property. Because then we can move very quickly at that point. If you come and you say, okay, great, you've won the deal, here's the contract and whatnot, and you wait till then to say, oh, I guess we better start to look for financing, that's when we're going to get into a bit of a box on timing, especially if your seller has the thumb on you, wants to close.
Yeah. And it's a competitive market, so that's what we see.
It is. I mean, we're seeing fast closings. We're seeing going hard day one on deals in order for people to get deals.
Yeah.
So it's a very competitive market right now. So.
Any issues with someone paying cash in that position that needs to be competitive, paying cash for that property and refinancing it with you right afterwards?
Generally, no.
Same type of financing?
Yes. Yeah. That does not hurt you in general. Okay. There are people, obviously not everyone has the financial ability to do that, but if you can, it's kind of a wonderful thing to do.
Yeah.
Because then you can be very aggressive in dealing with the seller.
Right. Close in
discount
2 weeks.
me X amount. We'll close in 2 weeks.
Right.
And
then take your time with the financing.
Right. With that type of situation, that's wonderful. Not everyone has the ability to do that.
Yeah.
But no. There used to be a thought that it impaired your financing ability,
right?
Because now it's kind of like
it's
a
refi.
Cash out.
Yeah.
It's a cash out refi now. Yeah. That's really not how the lending community looks at it.
Yeah. Well, that's good. Well, Tom, great information as usual. Thanks for joining us here.
Glad to be here.
All right. And stay with us. We'll have more on the multifamily market. I'm Michael Bull. This is America's Commercial Real Estate Show.